We're on.
Good afternoon, everyone. Welcome to the Ways and Means Committee. Today is Thursday, January 8th. We have 12 bills before us today. The issues for today, we start with the 2 gaming bills, 1 economic development, and 9 tax bills. So that's the order we're doing today. And we start with a bill from Allegheny County, House Bill 532. Delegate Buckle.
Thank you, Madam Chair. For the record, Delegate Jason Buckle. I am the chair, for better or for worse, of the Allegheny County delegation, and I have the privilege to present this bill to the committee today. House Bill 532 was in all substantial form submitted to the committee last year. It is also identical to a Senate bill which passed the Senate unanimously last year, but was not taken up for consideration given all of our circumstances in last year's legislative session by the Ways and Means Committee. Essentially, what the bill does is it maintains, with a few minor modifications, it maintains the current video lottery terminal rates and fees paid by the Rocky Gap Casino in Allegheny County, and maintains them at the rate at which they were originally set when the license was granted nearly 10 years ago. If the bill is not passed, in fiscal year 2023, the Rocky Gap VLT calculations will revert or reset back to the original calculations contained in the initial legislation authorizing casinos in the state of Maryland and setting forth the VLT percentages and where the monies would be allocated. And that would result in Rocky Gap effectively going to a 43% initial casino rate. Now, as many of you will remember that have been on the committee and with gaming, Rocky Gap and I believe Ocean Downs were the last 2 casinos in the state a couple of years ago who had not yet purchased their machines. They were still relying on the state to pay significant millions of dollars a year for the machines. This committee and the legislature passed a bill which gives them a 10% adjustment to the VLT percentages that they're allowed to keep, predicated upon them purchasing, maintaining, and operating their own machines at a fairly significant yearly cost, which they do. I don't want to get too buried in the math. I am not the committee's resident mathematician. Most definitely, I don't want Delegate Ebersol to quiz me on the math. But what I would suggest is that what we're really doing here is adjusting right now. The casino gets 50% as the base rate from the VLT monies. If there is no change in 2023, they'll drop 7 points to 43%. This bill would enable them, and they would still drop 1.25% from 50 to 48.25, but they would not drop all the way back to 43. The real adjustment, you would ask, well, where would the money come from? It's not taking money away from anybody who's getting it now. We're not stealing, so to speak, from someone who's getting a tranche of funds from the Rocky Gap monies today. All we're doing is maintaining the existing levels for things like the Purse Dedication Fund, the SMWOBA, Small Minority Women-Owned Business Fund, and the RFRA Fund. Rocky Gap does not contribute any money currently to RFRA. Under existing law, if we don't make this change, they would contribute 1%, 1 cent for every dollar lost to RFRA. All I would say to that is I'm a big believer in the horse racing industry. I want to support it, as I'm sure most of the people in our committee do. To be completely fair, there really is no nexus between the horse racing industry and economic development or jobs in Western Maryland. We're probably the only part of the state that can say that. We don't have the racetracks, the horse breeding farms, the training facilities that some of the other counties and regions where casinos are located have those. And so there's a more easy nexus between contributing some of these monies to support a local and statewide industry. To the best of my knowledge, we don't really have any horse racing facilities or breeding farms or training facilities west of Frederick, perhaps west of Carroll County in the state for a variety of reasons. So that's really where the money would change. Instead of us adding 3.5% in 2023 to the Purse Dedication account, adding 1% to RFRA in particular, we would essentially allow the casinos to stay on the same path they are and make the same payments they've been making. There is one interesting anomaly, I think, to the bill that we've discussed before. If the committee does nothing, just because of a mathematical oddity, If the committee does nothing in fiscal year 2023, the percentage of VLT funds from Rocky Gap that go to the Education Trust Fund actually declines by 1%. It goes from 32% to 31%. One of the fixes that we have in the bill is that we would keep the Education Trust Fund tranche from the VLT monies from Rocky Gap exactly the same. So they would stay at 32%. So the Education Trust Fund would continue to get the exact same percentage of those casino revenues from our casino as what they do now. And we think that's beneficial. And that's one of the main purposes of having the casinos, is to help support the Education Trust Fund. I won't belabor it too much more than that to say what I think all of you have heard me say before. While the casinos are very, very important economic development entities and job creating entities, and I'm sure every jurisdiction where they exist in Maryland, in Allegheny County in particular, they are one of our largest employers. They were one of our largest sources of local tax revenue. The local impact grants have an outsized influence and an outsized impact in Allegheny County. And you'll note from the bill, we actually are restoring the local impact grant fees. They were set at 3.75%, which was lower than any other place in the state. They will be raised to 5.5%, which is the standard for all other casinos. It's what all other casinos pay in from their VLT proceeds toward their local impact grant responsibilities. And what's very, very important to us is Rocky Gap's competitive posture is a little bit different than many other places in the state. Certainly Ocean Downs and the Perryville facility are neighbor other states very closely, and they have a lot of competition. Rocky Gap is the smallest casino in the state. The state of Pennsylvania has become the Nevada of the East Coast. They are putting in casinos and mini casinos all over the place, including at least two, one that is up and running in Greensburg, which is just north of Hagerstown in our neighboring county, and another one which is about to come online this year, depending on COVID, in Altoona, which is about an hour and 10 minutes northeast of us in Allegheny County. And so they have tremendous competitive pressures. And we want to encourage Golden Gaming, which is a publicly traded corporation that owns Rocky Gap now, based in Nevada. We want to encourage them to become bigger investors in the Maryland gaming market and in Allegheny County. They have, if any of you have been there, they have a resort, they have a Jack Nicklaus golf course, they have a spa, they have, a tremendous amount of amenities that also have a tremendous amount of costs. And we want to encourage them to not only stay and maintain what they have, but to feel certain that they can invest more monies for the future and help this grow. It is the largest tourist attraction overall in Allegheny County. And my guess is, I don't have the data on this specifically, but from talking to people in the tourism field, my guess is it is the largest tourist attraction in Western Maryland, other than Deep Creek Lake in Garrett County, an hour to our west. So I hope that the committee considers this. We think it's a win-win bill, helps the ETF, doesn't really cost anyone anything more than what they have, helps the operator maintain what they have and meet the commitments that the state has made. We've worked very hard over the course of a couple of years playing with these numbers and percentages. And in previous years, the committee has said, hey, maybe we don't need to do this year, but we think this is the year to do it because 2023 is when the numbers would revert. Thank you.
Thank you, Delegate Buckle. Any questions for Delegate Buckle? Delegate Ebersol.
Thank you, Madam Chair. Thank you.
No math quiz.
So Allegheny County delegation voted for this unanimously. Is that correct? All of
Yes.
you? Okay.
All of us. All four of us. All four of us.
I wasn't going to ask. So let's get a little historical perspective here so we understand for sure what's being asked for.
Sure.
You talked about the 10% that was given when they decided to purchase their own machines. That
That's
was
correct.
also awarded to another casino in Maryland. Is that correct?
I think it was Ocean Downs. I think Ocean Downs and Rocky Gap were the last two to come on, and other casinos also got percentages,
Right.
their machines, but that was done at a different time.
And I don't have the exact numbers. Either 7 or 8%. The 7 or 8% though was additional for Rocky Gap because if I get it, then I'm going to ask you because we were having trouble attracting somebody there. We were sweetening the pot for them.
There's a 7% difference between 43% was the original, let's just call it the default rate for all of the
Right.
casinos back when we put casinos in 12 years ago. Rocky Gap got 50 as its initial number, and that's exactly right because when
And now they're up to
they
60.
did at 43, the margins were not high enough and they got no credible interest.
All right. And now they're up to 60 because of the machine one also.
With the machine adjustment, that's correct. So they're
This
based.
bill wouldn't take the machine adjustment away. It would
No.
essentially take away the adjustment that was offered to attract them to Rocky Gap in the first place.
Yes, it would maintain, not completely, it would maintain, it would set it between the 43% that was the flat rate. And I would suggest that many of the casinos have had that 43% flat rate changed over the years. I think Maryland Live and maybe Horseshoe, their flat rate is above 43% because of other adjustments. It would take, instead of the 43% flat rate, it wouldn't be the 50% enhanced rate that they got back in the day, that 7% delta. It would set the standard rate at 48.25%.
So, but really it's
10%
different between
adjustment.
53 and 60, not 43 and 50, because they're actually getting 60 right now. They keep 60% of the revenues, right?
Right. The way I'm trying to explain it is their flat rate is 50 and then they got 10% because of the purchase. So now they would come in with a flat rate of 48.25. They would get 58.25.
I just want to make sure those listening know that they never really did 43%. They did 50.
Never.
And then they would have done 53 with machines had they not gotten the break. They got the break, so now they're at 60. They keep 60% of their revenues.
If we don't pass this
Right now.
the way to explain it to me, if we don't pass this legislation, they will revert back to a gross value of 53. They'll be 53 cents on every dollar that comes out of the machine.
If I can interrupt this conversation, the two of you.
Sorry?
And I know that Delegate Ebersole wanted to ensure that this was clear to everyone listening. I think this conversation is clear to the two of you and maybe few else with the level of detail and the speed at which you're going. Maybe some of this needs to be a conversation offline.
Good.
Do you have any
Can I
other
have just one more
Delegate
question though,
Ebersole?
Madam Chair? Just one more?
Sure.
Okay.
A real question, yes.
Yes, it is. You're right. That's true. So, well, it is. It's rhetorical too, but the sunset was always there. When they knew that sunset was there, right?
I would certainly assume so. I mean, I wasn't
Okay.
here at the time, and I certainly didn't represent. It's a different licensee now, but I can only assume they read the bill. I mean, or they read the law. Yeah,
And the new licensee would obviously make themselves aware of that also.
I would think so. But as we all
Okay.
know, economic matters change from year to year. So
Thank you.
Uh,
Thank you, Madam Chair. I appreciate your indulgence.
For sure, for only so long. Delegate Jones with a question.
Thank you so much, Chairwoman. Mr. Buckle, just for clarification, as I was fighting with my floor laptop at the same time, could you please go over once more how many folks are employed and the importance of that number?
there are, I think, about 600 in total employed by Rocky Gap. They're not all casino employees. I think the casino employees is somewhere around 400 and some. The largest single employer in Allegheny County is a little over 1,000. I think the Western Maryland Health System, which is a University of Pittsburgh Medical Center campus, is around 1,000. We used to have the Verso paper mill that was also in that neighborhood, and they closed down last year. So Rocky Gap is certainly one of our, if not top 5, certainly top 10 overall employers and a huge generator of revenue for the entire region.
And I'm sorry, did you say that it's probably now your number one tourist attraction for the region?
Most of the statistics suggest that it is the largest attractor of people from outside of Maryland or from outside of Western Maryland to come to Western Maryland. It's the largest one in our area, and it's probably second in all of Western Maryland, only to Deep Creek Lake.
Thank you.
Thank you, Delegate Jones. Are there any other questions for Delegate Buckle? I'm trying to figure out, I think this was sponsor only, but my cat's standing on my list here.
That's right.
Figure it out. This has never happened to me in the committee room before, so I beg your indulgence, Delegate Ebersole, and to everyone else. If there are no other questions, we're done with the hearing on House Bill 532. I'll turn things over to the Vice Chair.
Thank you, Madam Chair. Our next bill we'll have up, members, is House Bill 482, sponsored by Chairwoman Kyson.
Thank you, Mr. Vice Chair, and thank you to all of you today. I have a simple bill, if anyone has the word simple bill on their bingo card today, adding members to the Maryland Bread Race Fund Advisory Committee. And so currently the Bread Fund Advisory Committee has 5 members. This would be adding a 6th member, and that member would be recommended by the Maryland Thoroughbred Horsemen's Association. I think as you'll see by the testimony that's offered by the next two gentlemen, so exciting to see the first one who is here today to testify, returning to our committee. But pointing out that all of the horse interests have agreed to this change. So that's already been worked on. So that's all I have. And I certainly hope the committee can support House Bill 482. Thank you.
Thank you. Any non-rhetorical questions for the sponsor of the bill? Seeing none, thank you very much, Madam Chair. We'll go to the next speaker on this bill, Jason Weintraub.
Thank you, Mr. Vice Chair, distinguished members of the House Ways and Means Committee. It's good to be with you here this afternoon. For the record, Jason Weintraub on behalf of the Maryland Thoroughbred Horsemen's Association in support of House Bill 482. Back in 2013, the thoroughbred industry came together to support a groundbreaking incentive program to strengthen the state's horse breeding program. And by all accounts, that program has been a tremendous success and was subsequently extended in 2019. It's in that same spirit of cooperation that the Maryland Jockey Club, the Maryland Horse Breeders Association, and signed a joint letter in support of adding MTHA to the Bred Fund Advisory Committee Board. On behalf of MTHA, we want to thank the committee for its continued support of Maryland's thoroughbred industry and ask for a favorable report on House Bill 482.
Thank you very much. We'll take the next speaker before we take any questions. Alan Foreman.
Right. Good afternoon. Thank you, Madam Chair, for sponsoring this legislation, and thank you to the Ways and Means Committee. Just simply by way of background, Maryland was the first state in the country to legislate a program to incentivize and encourage the breeding and ownership of thoroughbred horses. Maryland created the Maryland Bred Fund through an advisory committee that created a bred race fund and a bred race fund program. The Bred Fund is funded by an allocation from the parimutuel handle. As you can see, the glaring omission from the advisory committee at this point is that the horsemen are the only stakeholder in the industry that are not represented on the committee. This is significant because, as Jason indicated, since 2013 and with invaluable assistance from Speaker Mike Bush, the horsemen joined with the breeders in the racetrack to create new incentive programs that would incentivize individuals to buy Maryland horses, own them, and race them in the state of Maryland. And the MTHA has been providing significant financial support for those programs, including a landmark agreement that we entered into in 2019 for additional incentive programs. As a part of that agreement, the stakeholders agreed and the Racing Commission agreed to create a seat on the advisory committee for the MTHA, but the commission was advised that it did not have the authority to add that seat without an act of the General Assembly, thus the need for House Bill 482. It is supported by, this legislation is supported by all interests in the industry, and we urge a favorable vote. I just want to take this opportunity to thank the chair, members of the Ways and Means Committee and the General Assembly for your ongoing and continued support for a vibrant Maryland treasure, the Maryland racing industry. And thank you for this opportunity to testify.
Thank you. Any questions of the two witnesses and speakers on this bill? Seeing none, thank you very much. That concludes the public hearing on House Bill 482. Madam Chair.
Thank you very much, Mr. Vice Chair. Delegate McKay, House Bill 443.
Thank you, Madam Chair. Madam Chair, Vice Chair Washington, my name is Delegate Mike McKay, and I always like to just start off with something a little funny. Madam Chair, I don't know if you remember when we were in high school in 1984 through 87, Wake Me Up Before You Go was on the top charts. That was Wham, the group. And as I get emails from W&M, I think of George Michael and Anthony Ridgely, who they are the ones that accredit me to my ability to bust the moves, as they would say. But in all honesty, I am here to present to you House Bill 443. This bill establishes a makerspace initiative pilot program. We are presenting sponsor only today because during the 2020 session, this committee passed out House Bill 1455, and the House of Delegates as a whole passed this bill out 20-0 and 131-0 respectfully. House Bill 443 is in the exact posture as House Bill 1455 in 2020. As you may recall, a makerspace is a space that allows individuals to creatively use their talents and execute their ideas. It's a place for individuals to start a business, a place for communities to come together and learn a new skill. Now, these spaces are not cookie cutter, and they must be reflective to the areas that they serve. We are fortunate to have 2 in Maryland that may be considered as the gold standard for makerspace. And a facility just off Greenmount Avenue in Baltimore City called Open Works. Mr. Will Holman, the executive director, has submitted favorable testimony for House Bill 443. And the second makerspace has opened in Allegheny County called Western Maryland Works. Just like Open Works, the facility in Allegheny County allows individuals to come and create and share their ideas. Placed at Allegheny College of Maryland, Western Maryland Works also has 3D printers, CNC machines, as well as other equipment that the Open Works has and focuses on workforce training. Now, this bill will fund through TEDCO, the Open Works, whether it's in an urban area or state or the rural part, the makerspaces are putting people to work. I look forward to, please look at my written testimony. In there is a link to a video that expresses the good news about makerspace in Allegheny County for someone who is looking for a job. Madam Chair and committee, I ask for a favorable consideration. Thank you for your time and grace, and wake me up before you go.
Delegate McKay, thank you so much. And to everyone wondering, of course, Delegate McKay and I went to Rockville High School together. I graduated 1 year early. If I knew his testimony was going to take a few minutes, I might have had time to run to my basement to find the yearbook for all of your benefit, but I wasn't sure how quick he would be or not, whether I could run that quickly. Any questions for my Rockville High fellow alumni? All right, Delegate McKay, thank you so much. Thanks for coming today. Thanks for joining us.
Thank you.
All right, our next bill, members, is House Bill 172. Delegate Lehman.
Thank you, Madam Chair. It is good to be back here in front of Ways and Means. I am here today to ask for your favorable consideration of HB 172, requiring combined reporting of corporate income tax by multi-state corporations in Maryland. This bill has been considered, as you know, by this committee many, many times. Last year, it did pass the committee amended, and it passed the full House. So HB 172 is the exact bill that you passed in 2020 with a deduction allowance for publicly traded companies to spread out the financial impact of the combined reporting requirement over a 10-year period. Companies that are eligible and want to take advantage of that deduction must inform the comptroller's office of their intention to do so. So there are a couple of basic arguments that you've heard before for combined reporting. The main argument tends to be that it's a fairness issue. So Maryland-only companies, including mom and pop businesses, pay corporate income tax in Maryland because they have to. And for small businesses in particular, they don't have the resources to, to discover and use legal accounting options that multi-state companies have to avoid paying Maryland corporate taxes. As an aside, in the last year, we've all seen the devastating impact that COVID has had on small businesses. In particular, in all of our districts, small businesses are shuttered. Many of them will never reopen because of the negative impact of COVID. And then conversely, many large companies have done very well during COVID. So the pandemic has really highlighted the disparities between large and small companies. The second argument that is literally growing each year in favor of combined reporting is that it is being adopted in more and more states. So New Mexico's combined reporting law took effect in 2020. That brings to 28 the total number of states out of 45 possible. Okay, not all 50 states is it possible to have combined reporting. So more than half, 28 of 45 have it, along with the District of Columbia. The sky has not fallen in those states, okay? There's been no job loss or other economic losses associated with the adoption of combined reporting. You have great written testimony submitted by the Center on Budget and Policy Priorities that totally debunks those claims. Madam Chair, I would urge you and all of the committee members to read that testimony. The Chamber of Commerce and others will say that corporations will not invest in Maryland in the future if we adopt this law, or that multi-state corporations that are already in Maryland will leave. Not true, according to Michael Mazeroff's testimony. There is no basis for that. He looked at Maryland's 120 largest companies. He found that a majority of those companies actually have facilities in combined reporting states. Specifically, more than half had facilities in 10 or more combined reporting states, and more than 25% of those companies had facilities in 20 or more combined reporting states. Now, even more noteworthy when you want to talk about job growth. Combined reporting states have done quite well growing manufacturing jobs in particular. The state with the highest manufacturing job growth over the last 10 years is the state of Michigan. It is a combined reporting state. And of 36 states that have had net manufacturing job growth over the last decade, 19 of those 36 have had combined reporting in effect for that entire period. Finally, HB 172 would be a revenue generator. It would bring in about $34.5 million in FY 2023, according to the fiscal note. That amount would increase to $126.6 million in FY 2026. There, of course, would be no local or small business effect. Madam Chair and committee members, it is time for Maryland to adopt combined reporting. With that deduction allowance that I mentioned in the beginning that mitigates its impact, it is time to do this. I thank you for your consideration, and I respectfully ask a favorable report.
Thank you, Delegate Lehman. Any questions for the delegate? All right, thank you. Seeing none, we're done with the hearing on House Bill 172. We're going to go next to House Bill 229. Thank you, Delegate Lehman. House Bill 229, Delegate Stewart.
Yes, Madam Chair, thank you very much. Madam Chair, Mr. Vice Chair, Mr. McTimerface, members of the Ways and Means Committee, for the record, I'm Delegate Vaughn Stewart, and this is HB 229, the throwback rule. This is also a reintroduction of a bill that you heard last year and that did pass the House of Delegates. The throwback rule, just as a brief summary of what we talked about last year, it addresses the problem of nowhere income. So because states can only tax corporations that have a significant or a sufficient nexus to the state, many multi-state corporations have nowhere income. That is, as you probably guessed, taxed nowhere. And so the throwback rule simply says that if a corporation has facilities in Maryland and also has income that isn't taxed in any other state, that income would be thrown back into Maryland and taxed here. And in my view, the bill has really become more important in the intervening time since the House of Delegates passed it last session for two reasons. First, the pandemic, as everyone knows, has put our fiscal situation in a somewhat less stable position as we try to fully fund public education, balance our budget, and also provide relief to thousands of struggling Marylanders. This bill will generate at least $50 million in revenue every year, which would be helpful for our budgetary situation. And secondly, as Delegate Lehman mentioned with the previous bill, the pandemic has really decimated small businesses. I don't need to tell you all that, but this bill is important because it'll level the playing field between those small businesses and the large multi-state corporations that currently benefit from this tax loophole. Small businesses need our help and will have a harder time digging out of this hole if we do not again pass this legislation. And finally, last year, the opponents of the bill claimed that it would release kind of a parade of horrors on the state. Jobs would be lost, businesses will flee, other businesses will refuse to come to Maryland. And they made these exact same arguments in their written testimony. But the problem is these apocalyptic warnings are contrary to all available academic research on this topic. So as we discussed last year, studies from the University of Tennessee, University of Oklahoma, Reed College, Brandeis University, they've all concluded that throwback rules have no significant impact on employment, investment, or economic growth. And if you remember last session, Delegate Ebersol asked the opponents to provide some studies to back up their claims that this bill would be so terrible for the economy. They were unable to do so then, and they still have not done so. So the throwback rule, ultimately, it's a win-win-win. It'll deter tax avoidance without hurting our economy. It'll level the playing field for Maryland small business owners, many of whom are struggling, and it'll generate funds for Maryland's recovery and for the blueprint. So I urge a favorable report.
Thank you, Delegate Stewart. Any questions for Delegate Stewart? All right, seeing none, thank you, Delegate Stewart. Thanks for joining us today. We next have Delegate Charkoudian with House Bill 330.
Thank you, Chair Kaiser, Vice Chair Washington, and members of the Ways and Means Committee. For the record, Delegate Lori Charkoudian here asking for a favorable report on HB 330, the Effective Corporate Tax Rate Transparency Act of 2021. So this bill, as the title suggests, is about transparency. I think I have a great deal of respect for all of you who spend your time deep in the weeds of tax policy. And I think, as you know, over many, many years, tax policy gets complicated, gets unraveled, gets complicated again. And we have a whole mix of rules, loopholes, credits, and then, of course, we have the way that federal and state tax policy interact with each other, sometimes very effectively and sometimes in ways that are really not very beneficial to Maryland. Ultimately, what that means is that even though on the books we have an 8.25% corporate tax rate, the reality is, and an analysis by the comptroller recently showed, the comptroller's analysis showed that at least 51 of the 150 largest companies, corporations in Maryland paid no corporate income taxes. And the reality is, as best as we can tell, there's very few large corporations in Maryland, certainly not the multinational, multi-state corporations that have a presence in Maryland, certainly not the publicly traded corporations in Maryland. Very few that, as best as we can tell, are paying that tax rate. Now, I could be wrong about that, but there's no way to actually know that because right now we don't have a mechanism to really see what are the actual tax rates that are being paid on the book value of what these corporations make. So what this bill does is it says for the publicly traded corporations have a presence in Maryland, we're asking them to add one more very small step to their tax filings. The very small step we're asking them to add is that after they go through a very complicated set of processes, one that involves multiple tax attorneys and experts on how to get the best out of any given state and federal tax law, after they go through all of that and figure out how to, generally, these folks are minimizing the taxes that they're paying. After they go through that, then they take the amount they actually paid and they make it a numerator, and the denominator, the division project we're asking them to do, is to take the book value, that is the profits that they shared with their shareholders, the profits that their company made and broadcasts to show that it's a profitable company, right? Take that value as opposed to the taxable income value and let us know what is the actual real tax rate that they're paying on that profit, the book value profit. And what that'll tell us, what that'll let us know once we have that data is how is the entire tax code, the whole tax code, affecting who pays how much in the way of taxes compared to their actual profits in this state. And I think what we'll probably, and then we get to have a really important conversation about that. Then we get to have the conversation about if the whole package of tax policies we have in the state allows the vast majority of multi-state publicly traded corporations to not pay taxes in the state while our small businesses are struggling for a lot of reasons right now and are paying their fair share of taxes, then maybe we'll start to look and readjust some of our tax policies. So at this point in time, this bill doesn't actually change anything in who's paying what taxes, but it gives us really crucial information that'll help us look at the tax policies as a whole in terms of their fairness. The one thing that I want to highlight about this is it also doesn't disclose to the general public or even to us which companies are paying which tax rates. What this does is it requires that calculation, which gets shared with the comptroller, then has that information, and then the comptroller creates a report for the General Assembly and the general public that'll show what the actual tax rates are that are being paid by these publicly traded companies and how it breaks down in terms of the industry, the size, the location, and so on. And so that'll give us some information that we can then use to assess our overall tax system and how we want to change it to make it more more fair, to make sure everyone's paying their fair share. The last thing that I want to say is that I have looked at and heard, you have heard this bill before, and we have heard from the opposition talking about how burdensome this is. And I just hope that maybe you would ask them to talk about, the amount of time and effort really that goes into these large corporations, which are the ones that we're talking about, the amount of time and effort that goes into preparing their taxes. It's an extraordinary process, because they are really trying to make sure they take advantage of every tax credit and so on that we have available, and how much more time it takes to put one number on top of another number and put it in a piece of paper in a form and submit it. So with that, I can, I'm not sure how you do it here, if you take questions directly, or I do have a panel if you want to hear from them.
Delegate Charkoudian, we'll start with questions for you. We have one from Delegate Buckle.
Great, thank you.
Thank you, Madam Chair. Delegate Charkoudian, by the grace of God, I'm not an accountant. I don't say that in any negative way towards my accountant friend. It seems like a very difficult and time-consuming process. So I'm not an expert at all in all of these different accounting terms and terminologies and net book value and depreciation over years and all the things that they're talking about. But all of the documents that have been submitted to us by things like the Council on State Taxation, Maryland Building Industry, the Retailers Association, the Chamber of Commerce, the Montgomery County Chamber of Commerce, which is probably the largest, I would suspect, individual chamber of commerce in the state. All of them seem to suggest that this would be not only a burden that you talked about, but that it really wouldn't reflect the reality of tax law. That it wouldn't take into effect policy decisions that we've made or that the federal government has made about how you can deduct certain business expenses, about how you can depreciate assets over years. So that all this would do is it would make it look like these folks aren't really paying 8.25% as a corporate tax rate, when in reality, all they're doing is following the laws that already exist. So what would be the purpose, if that's true, hypothetically, if what all the tax accounting people are saying, if that's true, hypothetically, what would be the value of the bill? What's the point other than to point out that tax policy allows corporations to deduct and depreciate and expense things in certain ways?
Yeah, thank you for that question. And I think I do want to be really clear that in putting this bill forward, I am not suggesting that anyone is doing anything illegal or inappropriate or anything that is at odds with the laws that we have set, we, the Maryland General Assembly, and that the federal government has set. But that is exactly the point. The point is that because we consider tax policy with this policy here, that policy there, that loophole there, that special interest there, that deduction addition here, what we don't have a way of knowing, what I certainly can't figure out with all of the tax codes that are, well, you can't really see with Zoom, right? But like, imagine I'm showing a fat book with all of that tax code. I can't figure out what does that actually mean. So what is Amazon actually paying in taxes in this state? Now, this bill wouldn't let me know what Amazon's paying, but it would let me know what all those big companies are actually paying after they do all the legal stuff that you described. It's all perfectly legal. But I would want to know that. I think we ought to know that. And the fact, I am alarmed, frankly, at the comptroller's letter from 2015 that 51 of the 150 largest corporations in Maryland paid no corporate income tax. Whatever deductions or tax credits or locational credits or whatever else we've passed, I don't think any of us ever intended to have large corporations in this state pay absolutely no taxes to the state of Maryland. I don't think that was the intention. And so I think what this gives us is an ability to do the analysis so that we can say, okay, so if that's what we've created, if that's what the big picture is, now maybe we want to go back and look at what are those specific deductions? What are the tax loopholes we've created? What are the tax credits we've created? And is that really what we want? Is that as important as it seemed at the time, given that the result seems to be when you put all of these together, that this percentage of the largest companies pay nothing and this percentage pay actually 1% and so on and so forth.
Okay, I appreciate that perspective. I don't completely agree with it, but I think that's a fair, straightforward way to say it. My only final question, if I may, Madam Chair. To your knowledge, are there any other states in the United States of America that require publicly traded corporations to do this additional calculation and analysis and disclose this information as part of their state income tax regimen?
Yeah, I appreciate your consistency. I think that you've been asking this question. And it's my sense that similar to last year, the answer is no. I know there was some consideration in Massachusetts. I will say that I don't think that's a reason not to move forward. I mean, there are things that Maryland has been first on. I'm sure there's, when people see what a great leaders we are in this area, that others will likely follow. I don't think, I mean, I think I appreciate that those who are fighting against this don't necessarily want this information out there because they're probably concerned that we might take a look at and change some of the loopholes that allow them to get out of taxation. I reject the idea though that it's somehow a burden, that adding two new pieces, like taking two numbers that already exist and writing them down on a piece of paper is such a burden that these companies would leave the state. So yeah, we'd be the first as best as I can tell, although I have other folks coming after me who might know if there's efforts in other states. But I don't think, I think that's a good thing, frankly. I think that we show the way for other states, and I'd be proud and excited to do that with you.
Thank you.
Delegate Charkoudian, I might agree with you on this bill, but are those things loopholes or policies that were created by the state of Maryland?
Well, I think it's, I mean, I guess it depends on how you look at it. I mean, it's a series of policies, and the question that I'm asking, that maybe I said loopholes, the question I'm asking is, how do all of those policies over time add up in terms of now what is being paid? And I'm not intending to criticize any particular policy, although I probably disagree with some of them. But right now, my question.
I thank you for your answer. I wasn't asking you to re-describe the bill. I was really just asking about the wording of the word loophole.
Sure. Thank you.
You do have another question from, another question from Delegate Palakovich-Carr.
Thank you, Madam Chair. Thank you, Delegate Charkoudian, for this legislation. Following up on Delegate Buckles' question, is it accurate to say that there are groups, though, at the federal level that are kind of reverse engineering what the effective corporate tax rates are for a number of companies, and in fact, highlighting each year that there are very big companies in America that are not paying any taxes?
Yes, there are a number of studies, and I don't have them handy, so I apologize for that. There are a number of studies that have been done at the federal level that point out essentially some of the same kinds of questions that we're asking here at the state level, but the federal studies, and I'm sure we could get them and share them if folks are interested, that do highlight how some of the largest companies in the United States, or multinational companies based in the United States, are paying nothing or almost nothing at the federal level, and presumably at the state level too, but we don't have that in front of us.
Thank you.
All right. Thank you, Delegate Charkoudian. We do have a few people signed up. I'll start with Michael Mazeroff.
Thank you, Madam Chair and committee members. I'm Michael Mazeroff with the Center on Budget and Policy Priorities. Thank you for the opportunity to testify in support of this bill. The bill would require publicly traded corporations to calculate and report to the comptroller their effective corporate income tax rates, and the comptroller would then issue an annual study compiling and explaining these data. And as the delegate just said, this bill will give policymakers a better picture than is currently available of how well Maryland's corporate tax structure is working to ensure all corporations pay their fair share of income tax. Maryland has a very weak corporate tax structure in comparison to many other states. Among other flaws, as you just heard in previous bills, it doesn't mandate combined reporting or contain a throwback rule. Requiring a calculation of the effective corporate income tax rate using book income would enable policymakers and the public to understand the cumulative impact of these loopholes and tax breaks. There will be great benefit in tasking the comptroller's office with ensuring the accuracy of corporations' effective tax rate calculations and issuing its own analysis of the factors explaining these data. The bill will be greatly improved by two amendments that I understand the delegate will offer. The effective tax rate is actual tax liability divided by a measure of profit earned in Maryland. Under the bill as introduced, the latter is determined using the existing apportionment rules. However, the current rules are not intended to be an accurate measure of profit attributable to Maryland. They were very deliberately enacted to provide an economic development incentive. So accordingly, the First Amendment would substitute the formula in the current version of the multi-state tax compact, which is sort of a normative apportionment formula based on tax policy principles. That would help identify the impact of the state's new single sales formula on effective corporate tax rates, which should be carefully studied going forward to determine if the purported economic development benefits justify the foregone revenue. And the Second Amendment would modify the requirement that corporations explain the impact on their effective tax rates of the book value of deductions and other line items on their tax returns by dropping the reference to book value of those items. Corporations' actual tax liability, which is the numerator of the effective tax rate calculation, is determined by the tax return value of those items, not the book value. Again, I thank the committee for the opportunity to testify. I recommend a favorable report on the bill with the amendments to be offered, and I'd be happy to take any questions.
Thank you, Mr. Mazeroff. Appreciate your testimony today. Next, we have Kaylee Shumitz.
Thank you, Madam Chair, members of the committee. My name is Callie Shumitz. I'm with the Maryland Center on Economic Policy. I'll be fairly brief. I think Delegate Charkoudian and Mr. Mazeroff did an excellent job of outlining why this bill is important, and we definitely agree with that. We know that the corporate tax rate that exists in statute isn't what many large multi-state corporations actually pay for a variety of reasons, as we just heard about in the two prior bills. Those are just some of the policies that allow corporations to reduce their Maryland tax responsibility. Regardless of your position on the underlying tax policies that contribute to a company's effective tax rate, we think that there is a benefit to having more transparency and more information to inform the policy discussions going forward. House Bill 330 would provide a basic level of transparency around the effective tax rate that corporations are paying, which would allow for better evaluation of the effectiveness of our tax system as a whole, as Delegate Charkoudian explained. It is, as has been mentioned, a very simple calculation and reporting process, and certainly represents far less effort than it takes for the companies to take advantage of all the corporate tax breaks that exist in the code today. So we would ask for a favorable report on House Bill 330.
Thank you so much. Sorry for mispronouncing your first name. I apologize. Next, we have Matthew Gardner. Is Mr. Gardner here?
Oh, yeah, sorry, I was on mute.
Okay.
Thank you, Madam Chair, members of the committee. I appreciate the opportunity to testify today. My name is Matt Gardner. I'm a senior fellow at the Institute on Taxation and Economic Policy. We're a DC-based research group, and we have done a fair number of the calculations that a couple of you have referred to, trying to assess effective tax rates paid both at the federal level and nationwide at the state level by large corporations. So I'll talk a bit about that and try to fill in some blanks. I've submitted written testimony that makes 3 points, and I'm going to touch on each of them as well. First, we know based on our own research that nationwide, state corporate tax avoidance is a large and growing problem. My organization found in a report we published a couple of years ago that more than a third of the biggest corporations found ways to pay zero nationwide in at least one profitable year between 2008 and 2015. Again, that's nationwide state corporate income taxes. But in general, we don't know why, on a case-by-case basis, this is happening. You know, which tax breaks are being used by these companies. And almost without exception, we don't know, based on this information, how specific states' budgets are being affected by this nationwide state tax avoidance. So does zero nationwide mean zero in Maryland? We just can't tell from the limited financial reporting that the Securities and Exchange Commission currently requires of all publicly traded corporations. So there's this informational void. We know that many corporations are finding ways to get down to zero, but it's impossible to tell in general the extent to which Maryland is being affected by this. The second point to make in the testimony is, and it's an important one, I think, is that you as lawmakers really should, must, I'd say, have access to this information. This is a critical time for assessing the long-term viability of states' revenue streams, and knowing who's paying, who's not, and especially why is vital information as you seek to evaluate the health of the corporate tax going forward. The last thing I'd say is I'd put this in the context of what's happening more broadly in the nation. A couple of you have talked about what other states have done. Certainly, this is a thing that's a topic in state legislatures around the nation right now. California seriously considered a similar bill last year. But the broader context for me is that this is happening at a time when the US government and other nations are beginning to recognize the importance of international data sharing on the national level taxes paid by specific companies. We all understand that foreign tax havens are really an existential threat to the corporate income tax at the national level, and it's similarly true at the state level. So from that perspective, I'd say HB 330, rather than sort of a departure from what everybody else is doing, would represent a welcome and vital extension of a clear national trend towards greater information sharing and an extension of that to the state level. Appreciate the opportunity to testify. I'm happy to answer any questions on this.
Thank you so much. I want to thank all three of you for testifying. I want to give an opportunity to committee to ask any questions on this bill. Any questions of the proponents? All right, seeing none, we'll move on to the opponents. Stephanie Doe.
Good afternoon. Chair Kaiser and members of the committee, thank you for your time, especially under these very unusual circumstances that bring us together over Zoom. My name is Stephanie Doe, and I'm a senior tax counsel at the Council on State Taxation, also known as COST. COST is a nonprofit trade association based in Washington, D.C. We have an independent membership of over 500 multi-jurisdictional businesses, many of which have business operations and activities in Maryland. And COST's objective is to preserve and promote the equitable and non-discriminatory taxation of multi-jurisdictional businesses. We oppose this bill, and you have my written testimony detailing why this bill should not move forward. And though we greatly respect the legislators' need for information in order to make wise tax policy choices, I would just like to use this time to emphasize one point, and that is that this bill adds administrative burdens without adding additional information. There's two reasons for that, two big ones. The first, this bill creates inaccurate information. The bill attempts to determine a business's effective tax rate by comparing its Maryland tax liability to its book income. But using book income is not the right comparison. Instead, it should be a business's taxable income, because that is what's used to determine its tax liability. Book income departs from that taxable income, and taxable income reflects permanent and temporary accounting timing differences, which this bill would not reflect. And second, this information requested by this bill is already provided to the comptroller and would simply add a burdensome redundancy. For these reasons, we respectfully urge this committee to issue an unfavorable report on this bill, and thank you again for your time.
Thank you. Do we have any questions? Delegate Palakovich-Carr.
Thank you, Madam Chair. Thank you for the testimony. I would like you to point out where exactly this information is reported to the comptroller. I believe this is the third year that that claim has been made. My due diligence, that information is not reported to the comptroller's office. So I think it is on you all to actually prove that point at this point. Thank you.
Sure, absolutely. Thank you, Delegate Carr. So your Maryland state tax liability and your allocation factor is already included in your Maryland tax return. For book income, that's provided in your federal pro forma tax return, which is also included as part of your Maryland tax return, which is Schedule M1.
Any other questions? And again, the delegate's name is Delegate Palakovich-Carr. The next delegate with the question is Delegate Feldmark.
Thank you, Madam Chair. I actually have two questions, please. The first one is short. I believe you said that the information we should be seeking here is tax liability divided by taxable income. Is that correct?
Yes, that's the more apples to apples comparison.
Okay. And if you divide tax liability by taxable income, in what scenario would that be anything other than our corporate tax rate?
That would, if you're taking your individual company's tax liability and you're comparing it to that company's taxable income, that should equate to that company's effective tax rate.
And in what scenario would that be different from Maryland's corporate tax rate?
Your Maryland's corporate, I understand what you're asking.
I mean, you calculate your tax liability by taking your taxable income and multiplying it by the corporate tax rate, correct?
Yes, I understand what you're saying, Delegate Feldmark, I'm sorry. You're correct. The comparison that we're urging is that this is an apples to apples situation, which is you have to look at your taxable income versus your book income. And I understand that does equal your Maryland's tax rate. And again, I would say that to that, I would emphasize that this information in terms of what your book income is already reflected in any corporation's federal pro forma, which has to be included in a Maryland tax return.
Okay, and I just wanted to follow up in explaining your organization's mission. I believe you said you were that you advocate for non-discriminatory tax policy. Is that correct?
That's correct.
Do you feel that this would constitute discriminatory tax policy?
Within that umbrella, cost is opposed to measures that request additional information that is unnecessary in order for legislatures to move forward with wise policy choices. So as a general matter within that equitable and non-discriminatory taxation umbrella, we oppose bills that require additional transparencies than is what is needed to make tax policy choices.
I guess if I can just push you to be a little bit more clear about what is discriminatory about transparency. If we are asking all publicly traded corporations to be transparent, what is the discriminatory element in that policy?
That's because you're also, for one, you're asking publicly traded corporations. It's not all businesses that are being required for it. And businesses, especially publicly traded corporations, we also have private corporations that are members of COST. All are uniformly opposed to additional burdensome measures that are already in addition to their existing compliance measures. States have already required, states and localities already require a voluminous quantity of compliance. Every single state and every single locality that has taxing jurisdiction requires multi-jurisdictional businesses to report and comply with their taxes, and that is already a huge burden to bear.
Thank you.
Thank you.
All right. Thank you all very much. Are there any other questions on this bill? All right. Thank you. Seeing none, we're going to move on to House Bill 421 from Delegate Rosenberg. And before I do that, I would mention that there's quite a few people on the Zoom that think that Delegate Shoemaker looks like our president, given his glasses, which he may now throw away. But I did want to make sure everyone took a look at him. House Bill 421, Delegate Rosenberg.
Thank you, Madam Chair, and members of the Ways and Means Committee. As this committee well knows, and as the last bill emphasized, our tax code is complicated. Corporations, people with income, have accountants to enable them to pay the tax that they should be paying and not pay the tax they shouldn't be paying. Low-income Marylanders, in large measure, do not have that benefit. This bill would increase the number of low-income Marylanders who do have the benefit of advice regarding their tax obligations by establishing $250,000 annually in the budget to be distributed equally, one-third, to legal clinics at our two law schools, the University of Baltimore and the University of Maryland, and at the Maryland Volunteer Lawyer Service. This is legislation that the committee passed last session with two changes. One is that there's no specific source other than the income tax itself, income tax revenues themselves for the fund, and an amendment that is being prepared. The money would be divided equally one-third. The principle of this bill is the same as it was of the legislation that the committee passed out last year. That is, we should be using the two law schools and MVLS as an opportunity to both provide tax counsel for low-income Marylanders who would not otherwise receive it, as well as to educate the students at the two law schools, not only about income tax, but about the merits of providing legal services for the poor. So I would urge a favorable report with the amendment that will soon be before the committee for House Bill 421. Thank you.
Thank you, Delegate Rosenberg. Are there any questions for the delegate? All right, thank you. Seeing none, we do have a few people signed up to testify. I'll start with Janice Shee, and then Dean Tobin and Ronald Welch. Ms. Shee?
Hello, hi. Thank you, Madam Chair and Mr. Vice Chair and distinguished members of the committee. Thank you for the opportunity to testify today. My name is Janice Shee, and I am the director of the Low Income Taxpayer Clinic at Maryland Volunteer Lawyer Service, the oldest and largest pro bono provider of legal services in the state of Maryland. I am testifying in support of this legislation. Members of the committee have my written testimony regarding House Bill 421. On the back are two typical client stories illustrating the types of clients that we see and why this legislation is so important. But I would like to share one more story, and this is the story of Miss Doris. Miss Doris is 94. She's partially blind, a retired domestic worker at the beginning stages of dementia. Her only income is Social Security. Her husband, now deceased, took care of her finances. After he died, Miss Doris understandably fell behind in her tax filing. Her daughter, who has power of attorney, was able to get Miss Doris back into filing compliance. However, she also learned that Miss Doris was a victim of financial exploitation. Friends of her mother had asked her to redeem lottery tickets for them, and Miss Doris, not capable of understanding what was happening, was just trying to be helpful. She did not understand that this was going to be income to her, resulting in a tax bill with penalties and interest, which ballooned up to $65,000 and a lien on her home. So Ms. Doris came to MVLS, and a volunteer was able to resolve the issue with an offering compromise for just $50. So I repeat, Ms. Doris, 94, partially blind, retired domestic worker in the beginning stages of dementia, a tax bill of over $60,000 resolved with $50. She could not have done this on her own. So, and this is why House Bill 421 is so important. Clients with Maryland tax issues are often scared and confused. They're afraid of going to jail, and they're anxious about dealing with the Maryland Comptroller's Office. We can help. Thank you for this opportunity to share this with you.
Thank you so much for your testimony. We next have Dean Donald Tobin from the University of Maryland Carey School of Law.
Thank you, and thank you for having us here. Chair Kaiser, Vice Chair Washington, and members of the committee. Donald Tobin from the University of Maryland Francis King Carey School of Law, and I'm pleased to join with my colleagues in expressing our strong support for HB 421. I think Janice Shee's comments gives you a sense of the individuals get impacted about this, and I want to talk to you about it on a little more macro policy angle, and that is we have an absolute crisis in this country about equal access to justice, and that includes economic justice, and there has been a focus more and more on ways that we can help the least fortunate among us. And one of those key areas is low-income Marylanders who often don't have representation when they're before tax authorities. We have a grant, as do all of us, from the IRS to support low-income taxpayers with federal tax disputes. And we are allowed to help Maryland taxpayers who are connected to that federal tax disputes. So we do help Maryland taxpayers, but we are not allowed to help Maryland taxpayers if they have only a Maryland tax issue. We're also not allowed to do outreach that is specific for Maryland. So, so this bill would allow us to be able to add on to our existing processes more service for Marylanders and
Dean Tobin, we can't hear you right now.
Can you hear me back?
Yes.
I've been teaching class, you figure this shouldn't happen, but we think that this benefits both the people of Maryland, but also the state, because it creates efficiencies for people to process the tax delinquencies in the comptroller's office. So, so we believe this is a win-win. I'm a barred attorney in Maryland. I help in our tax clinic. My underlying specialty is tax. And when I started helping in the tax clinic, I quickly learned about the problem that our taxpayers have with dealing with and navigating a very complex system. So just to explain a little bit, and I know this is your committee, you do this more often than others, but people don't really understand that tax collection is like almost nothing else we do in our system, and that it's a civil action, but because it's brought by the government, the litigant bears this burden of proof, of showing that they've met the requirements or that they've done what they need to do. And most taxpayers are simply not trained to grapple with the law in that sophisticated way. And wealthier people can afford lawyers, but poor people can't. And in those cases, we become a lifeline for those taxpayers. So I spent a lot of time at DOJ. I was a tax lawyer at the Department of Justice. When we do tax administration, our goal is to get it right. A fair tax system collects a fair amount from each taxpayer. We don't seek to collect more tax than is due. And therefore, providing representation to low-income taxpayers who would not otherwise be able to afford it simply helps us ensure a fair and equitable tax system, which is, I think, what we all actually want. HB
Dean
420.
Tobin, your 3 minutes are up. Can you summarize your ending?
I have my last sentence. HB 421 helps hardworking taxpayers, and I strongly urge the committee to provide a favorable report.
Thank you so much. Ronald Welch here from the University of Baltimore School of Law.
Thank you, Chair Kaiser. My name is Ronald Weich. I am the Dean at the University of Baltimore School of Law, and I very much appreciate the committee's invitation for all of us to testify today. My colleagues have well stated the merits of the bill, so I won't repeat their testimony. And of course, you have my written testimony. I'll go one better than my friend and colleague, Dean Tobin. He said it was a win-win. And I'll say this is a win-win-win, because not only does it benefit Maryland taxpayers who very much need legal representation in these sometimes complex disputes, and so we would be expanding access to justice. Second, it would, as Dean Tobin said, assist the Comptroller's office because they can better resolve these matters when they're dealing with an attorney on the other side of the table. And then finally, the third win is for the students at our two schools. These are very worthwhile opportunities for our students to learn about tax law. And as Delegate Rosenberg said, the benefit of providing legal services. We are both public law schools, so it's entirely appropriate for the legislature to assist us in this way, as you already assist us through state appropriations. So in that respect, you would be furthering legal education in the state and helping us produce the next generation of lawyers who will be committed to serving the public. Finally, I just want to thank Delegate Rosenberg. He's been a great friend and supporter of our schools. He teaches at both schools, and we are very indebted to him for his sponsorship of this bill. I urge favorable reporting of House Bill 421.
Thank you so much. And Dean Weich, sorry for having mispronounced your name.
No problem. Happens all the time.
Any questions for the three who had testified? Thank you all very much. Really appreciate you joining us today out of your busy schedules. We will, members, we're done with the hearing on House Bill 421, and we're moving on to House Bill 511. Delegate Valentino Smith.
Thank you.
Thank you, Madam Chair, members of the Ways and Means Committee. It is nice to see you all on Zoom and the square boxes that I see. And are we all still playing the game of who's still wearing pajama bottoms or not as we proceed? It's good to be here. I've come before a couple of years in a row each year. This year it's House Bill 511. It's a tax exemption bill for the permanently physical disabled that continue to work. And I appreciate you have 12 bills today. You're the committee that is tasked with reconciling individual taxpayer burden in the state of Maryland and what we can and should do each year with respect to tax burden, be it for individuals or businesses. What House Bill 511 does is it pops into that section of law 10-211 for individual exemptions. And it says, for those that are permanently and physically disabled but work, they're entitled to a $1,000 exemption. Under current Maryland law, there's a $1,000 exemption for those that are physically disabled by blindness. But that's the only physical disability for which someone can avail themselves of the tax exemption. So the bill seeks to expand that to those that are physically disabled and continue to work. And as you know from the prior years that I've come, only about 39% of Maryland adults that are physically disabled actually maintain active full-time employment. And those that are physically disabled and are employed make 30% less than those of us that are not disabled overall in the employment market. And so allowing them this $1,000 deduction helps them with the added costs that they have. They make major adjustments to their living spaces. They have to make adjustments to their vehicles. They have to make adjustments to the types of food they eat, which are often more expensive because they use more prepared food often due to the physical disability. They have increased co-pays and costs for things that assist them that aren't covered by insurance. In the current tax code, we allow those that are permanently and physically disabled who do not work, to avail themselves of pension exemptions. So what this does is say in our tax code, for those that are disabled and do work, we are going to provide you with the $1,000 exemption to help offset the additional costs you have, and we recognize the tax burden that you have. I apologize. I do have an amendment. I offered it last year and missed it when I sent the bill over for filing. What the amendment does is it requires the same attestation that the comptroller looks at when it makes the decision for the permanently physical disabled to file for their pension exemption. And what it then would require for those that are submitting for this exemption, that they submit a letter from a qualified physician certifying the nature of their disability, that the disability is expected to continue indefinitely, and that the individual is capable of substantial gainful activity. So it's consistent with what our tax law already provides for the disabled in terms of the attestations that they need to make to be available for the exemption. With respect to the fiscal note, yes, obviously it does have a fiscal note. It's more, it's about 3.4 million. And I believe all of that money is likely to come right back into the economy in the state of Maryland with the disabled spending it here in the state of Maryland. With respect to opposition, it's difficult this year because I used to send my staff down to tell me who signed up to oppose me. And obviously we can't do that yet, but I'm going to suspect that it's MACO who had the same opposition that they had last year. And I'm not going to take it personally because as I read it, it looks like standard opposition that they send to most of you all the time saying that they just don't support tax exemptions in the state tax code. So with that, in all of the balancing that you're going to do this year and all the decisions that you're going to make, whether it be tax credit or tax exemptions, I continue to implore you to consider the permanently disabled that work and offer them the same $1,000 that are offered to those that are blind. And I know the chair likes history, or she at least likes the perspective of where things came from. And the original part of the code started back in 1989 when the state tried to adjust our exemptions because the federal tax code had made a bunch of changes that impacted Marylanders. So it started to offer Marylanders some exemptions to offload the additional federal tax burden. And as you know, and you grapple with, the federal law did change a couple years ago, and we hear from a lot of constituents. And over the years, we've tried to tinker with some of the exemptions to, adjust for that tax burden, given what the federal government did. And so I think maybe this can be up there for your discussions again this year on how we can help these individuals with their tax burden. Thank you.
Thank you, Delegate. Delegate Barnes has a question.
Thank you, Madam Chair. And thank you, Delegate Valentino Smith. I just had a small question. That is, what type of disability would qualify you for this type of an exemption?
So that's a good question. Thank you. Because often in terms of the definition for disability, it includes both cognitive and physical. And for purposes of this bill, what it says is it's limited to physical disability. And so it would ride with the current definitions that the comptroller has for physical disability, and the doctor would have to certify that it's a physical disability. That's what's maintaining the fiscal note down, because we did not, although we would believe that those that have cognitive and mental disability are worthy of the same thing, we thought we'd try and walk before we could run with the proposal that it be limited to physical disability. And in the fiscal note, they're using estimates from the Board of Revenue on those that are already physically disabled.
And can you send over to us what physical disability is?
Yes.
Thank you.
All right. Thank you, Delegate Barnes. Any further questions? No? Seeing no further questions, thank you, Delegate Valentino Smith. We do have 3 people signed up in favor of the bill, starting with Andy Culp.
Yeah, good afternoon, Chair Kaiser, Vice Chair Washington, and members of the committee. My name is Andy Culp, and I'm testifying today on behalf of the ARC Maryland, the Maryland Association of Community Services, and the Maryland Developmental Disabilities Council, all statewide advocacy organizations who are committed to improving the opportunities and outcomes for Marylanders with disabilities. And we support 511, House Bill 511, because for the reasons that the delegate already laid out. So I'm just going to touch on a couple of points. Delegate Barnes, to answer your question, a physical disability is defined as a limitation on a person's physical functioning, mobility, dexterity, or stamina. So this would have to be a permanent condition that a doctor would certify. And physical disabilities also include impairments which limit activities of daily living, like respiratory disorders are considered physical disabilities, blindness, epilepsy, and sleep disorders. So by kind of pulling in physical disabilities, we're just expanding on what's already in current statute, which is that people who have blindness, which is one form of physical disability. All people with physical disabilities could be eligible for this exemption. Just pointing at the fiscal note, I know that it shows some revenue loss to the state, which is another thing that the delegate pointed out. If the additional deductions were allowed primarily to income tax decreases. However, the analysis may not fully take into account that Maryland's an employment first state, which means that we look at employment as the first option when people with disabilities leave high school. But barriers currently exist for many people with disabilities to obtain and maintain their employment, to support themselves while also having the ability to contribute payroll taxes to our state. So, some money will not be coming in, due to this exemption, but they'll be working more, hopefully. So anyway, in wrapping up, I would just like to conclude that the ARC Maryland, Maryland Association of Community Services, and the Maryland DD Council support 511 because we believe it'll benefit everyone. Thank you.
Thank you very much, Mr. Gabal, Patrick Gabal. Thanks for joining us again today.
Yes, thank you, Madam Chair Kaiser. And it is the honorable members of the House Ways and Means Committee. It's good to be back with you again twice a week. So anyhow, I'm Patrick Gabal, Vice President of the Maryland Military Coalition, and I join you today in support of House Bill 511. We believe this measure will enable those afflicted by permanent disabilities to enjoy a better life even while they're working. And be able to have a greater income to afford the necessary essentials, thanks to a lower tax burden that they presently endure. This means having more food, clothing, and housing while living with a disorder that they will have to live with for the rest of their life. The Maryland Military Coalition has organizations such as the Disabled American Veterans, the Veterans of Foreign Wars, and others who have members who live under these intense restrictions, and we are sure they would be deeply grateful for any assistance. We strongly applaud Delegate Valentino Smith for continuous support of the disabled and the veteran communities, and respectfully request a favorable report on House Bill 511. Thank you, Madam Chair.
Thank you. And thank you again for your service. Next person we have testifying is Lori Scott.
Hi, good afternoon, Chair Kaiser and members of the committee. Thanks for having me today and allowing me to speak in favor of House Bill 511. And I want to thank Delegate Valentino Smith for continuing to bring this forward. I have a daughter who's 18 years old who does go to some volunteer and job coaching opportunities when we are in school. And unfortunately now that's not going to happen, and maybe later on this year, hopefully it will. But she is completely dependent on us for all of her activities of daily living, her housing, social engagements, van transportation. And of course, I can't forget some of the things that we had to purchase this year in school supplies due to COVID. So we had to have an adaptive floor chair, iPad apps, manipulatives, adaptive equipment, and the list continues on. Those are things that we had to purchase for her. So any additional exemptions to help pay for some of these expenses, since her job and her volunteer opportunities now are minimized, would certainly be helpful to our family, especially under these circumstances with COVID and the loss of annual income in our home. So I'm here to support this, and I hope that you will consider also doing that to help families like mine gain a tax exemption to help offset some of the costs and support those people with long-term physical disabilities. Thank you for your time today.
Thank you so much for your time. Any questions for the three individuals who had just testified? Thank you all very much. Thank you for coming today and being part of the democratic process. We're done with the hearing on House Bill 511. We're now moving on to the tax bills from members from our committee, starting with the House Bill 142 from Delegate Ivey.
Thank you, Madam Chair, colleagues. For the record, Delegate Julian Ivey here presenting House Bill 142. Under state law, MHEC may approve student loan debt relief tax credits up to $5,000 for Maryland residents with qualifying loans. In 2019, the commission awarded $9 million in credits, which is the maximum amount. This legislation, as introduced, would increase the annual amount of credits, which the commission may award up to $100 million. Second, the bill would increase the maximum value of the credit to $100,000 for an individual. And lastly, this bill would expand the eligibility, the tax credit, by eliminating the requirement that a student must have had at least $20,000 in total student loan debt and have a remaining balance of at least $5,000. The student loan debt crisis looms large over our country, but here in Maryland, it's more of a crisis than it is for other states. According to educationdata.org, Maryland residents have the highest average student loan debt out of all the states, with an average of $42,700 in 2020. The total student loan debt in Maryland was $34.2 billion, with over 800,000, Marylanders carrying that debt in 2020. Currently, close to 50% of Maryland student borrowers cannot qualify for this tax credit because they don't have enough debt. Presently, to qualify, an individual must owe at least $20,000. Today, I have Ben Alpert, the SGA president from the University of Maryland, along with a former classmate of mine, Hugo Cantu, to speak on behalf of this bill. I also want to thank the Maryland Legislative Coalition, public policy partners, and the Prince George's County Young Democrats for providing written support for House Bill 142. With that, Madam Chair, I'm asking for a favorable report.
Thank you, Delegate Ivy. Any questions for the delegate? Seeing none, we do have 3 people signed up. We'll first take Dan Alpert. Is Dan here?
You know what? I just got a text from him. He's in class right now.
Okay, we next have Grishma Anand. Well, you know what? It's going to have to be. Well, you know, we are very fortunate today to be joined by Hugo Cantu, who was one of my students in my Women in Leadership class a few semesters ago. You may all recognize him as an intern for and employee of Delegate Walker, but he has since moved up in the world and works for Council Member Walker in Prince George's County. So Hugo, it's great to see you today. Hope you're doing well, and it's all on you today. The others weren't able to make it.
Hey everyone, thank you so much. Hi, Chair Kaiser and Vice Chair Washington, and thank you, Julian. Delegate Ivy. I'm just coming from County Council. We just passed my first resolution today, so I'm really happy about that. But I came here to talk about Delegate Ivy's bill. So I urge a favorable report as a private citizen. I sit here as a Latinx alumnus from the University of Maryland School of Public Policy undergrad program. I sit here on a mountain of debt. I sit here as a former intern of this very committee. I sit here as a current policy analyst. I sit here as a son of an immigrant, of immigrants, and I had to watch my immunocompromised mother earn every grade on her way to graduating summa cum laude and becoming a nurse, only to be met at the doors by COVID-19 this past year. For many years, you know, while my mom was studying in school, we struggled financially. For a lot of low-income individuals, you know, going to college and leaving with a degree is the only way for upward mobility. And if you're living in poverty, it's about 90% chance of getting out of it if you leave with a college degree. Give you a reference point, inequalities across demographics, the median wealth for a white family has about 41 times more wealth than the median wealth of a Black family. And when the median wealth of Latino families are compared to the median white families, we're looking at a difference of about 22 in favor of white families. I'm speaking to a group of policymakers and decision makers. I'm well aware that there's no easy fix, no one size fits all. However, the increase of tax deductions related to the student debt for those brave enough to get an education when everything is going against them, this bill can play a much needed part in closing a lot of those inequities. This bill isn't just for recent college graduates or recent people that young folks that are just leaving college. I mean, this bill is for everyone. This bill is for my mom, for when she was in school and we didn't have money to go to the grocery store sometimes. So this bill isn't just for recent graduates, it's for closing the financial gaps and giving relief to mothers and fathers and people that know education is the way out. Because the punishment for not obtaining a degree is far surpassing the reward for getting one. I urge a favorable report, and I want to thank everyone for being on the call. I want to thank everyone, and it's a pleasure to see everyone. Hi, Professor Kaiser. So thank you.
Thank you, Hugo. Again, really good to see you. Glad everything's going well for you. Any questions? All right, seeing none, we're done with the hearing on House Bill 142. Again, Hugo, great to see you today. We're next moving to Delegate Smith, House Bill 275.
Thank you, Madam Chair, and thank you to all of my colleagues on the committee. For the record, I'm Delegate Stephanie Smith. I'm here before you begging your careful consideration and ultimate support for House Bill 275. In the 2020 session, I did bring a very similar bill before the body. And I guess, you know, that was in the world before COVID. But even in that world before COVID, there were so many needs that we had as a state that weren't being met. There were parts of our state, particularly the greater Baltimore region, that still had extremely underperforming and lackluster transit. We as a state are endeavoring to strengthen our public school quality, the rigor of the training for our teachers, and just creating an environment where we're more competitive globally. We knew that was going to have a cost. And then there's all the challenges that we've had prior to COVID around how we could better support those who are facing all types of challenges. You've heard a few of those challenges even just today of Marylanders who are navigating life with disabilities, of seniors who are trying to figure out how to live the remaining decade plus of their lives with as much dignity and comfort as possible. And of course, the ongoing challenges for different parts of our state to realize certain forms of economic development. There was always a cost to improving quality of life for Marylanders prior to COVID. And now that we're in the midst of the ongoing moment, which is COVID-19, there are costs related to getting through this moment. There are costs related to figuring out how we ensure all of our constituents and neighbors and friends are adequately vaccinated. There's concerns around how small businesses are going to survive as we continue to largely operate and shelter in our homes. There's also ongoing costs related to this pandemic as it relates to folks that have simply lost employment and are very close to losing their home due to not enough money for rent, not enough money to cover their mortgages. So I wanted to paint a picture. Prior to COVID, we had a lot of unrealized educational, transit, infrastructure, and other dreams for Marylanders to be as comfortable, to be as dynamic, and to be a place that people not only want to work, but live, play, thrive. But in the midst of the pandemic, people are simply trying to survive. And I think it begs of us to think about how we fund fairly a way to create a better economy, a more inclusive economy, but also how do we get through this moment, not simply racing back to the status quo pre-pandemic, but really thinking outside of the box. We are charged as stewards of tax dollars, of Maryland tax dollars, to not simply just do whatever's been done, but to also think about how we can institute fairness along the way and ultimately yield more resources so that we can actually not always be in response to challenges, but maybe help prevent them by making sure that we're adequately educating our populace, that we're protecting people from unforeseen challenges like the pandemic by actually having the funds and the strategies in place before we face this type of challenge again in the future. Because I want to be frank, there will be another threat in the future. We might not be able to determine what it will look like or all the details, but again, part of our fiscal stewardship is about anticipating a portfolio of tools be available so that we can navigate this and minimize harm. So that's my preamble to why I believe we need a fairer and more just income tax system in the state of Maryland. Under our current system, those who are working for their income, not those who've largely inherited income, but those who are working for their income, the vast majority of working Marylanders pay a much higher tax rate than the top 1% of Maryland households. And when you look at that top, 1% of Maryland households, over 60% of their income is largely derived from inherited wealth, not from going out and working or simply doing what we're doing, working remotely on a computer. So I think when we're thinking about how we want to remain fiscally strong as a state, we need to have a fairer and more just income tax system, along with an analysis of a lot of our tax system beyond income tax to see how we can not only respond to the moment we're in, but be better prepared to navigate challenges of the future. So the fiscal note that you should have access to shows that if we were able to largely reduce the tax burden for lower households and increase more fair tax obligations for those households, particularly those that make in excess of $200,000, you can look at more revenues for the very things we knew we needed before the pandemic, and we're going to continue to need through and after the pandemic is concluded. So in just the first fiscal year, you're looking at increasing revenue by $300 million through fiscal year 26, looking at just shy of $700 million in additional revenue that we can use to not only bring relief, but to anticipate challenges and actually on the front end, just create a higher quality of life across Maryland. So I thank you for your indulgence, Madam Chair. I know there are maybe a few people signed up, and there's also written testimony for your review, but I do beg your careful consideration of this proposal and hope for your support of House Bill 275. Thank you so much.
Thank you, Delegate Smith. Questions, Delegate Buckle.
Thank you. How is my favorite Democratic Steelers fan in the General Assembly?
You know, in the beginning of the session, at the beginning of the season, it was the best of times, and by the end of the season, it was the worst of times.
I don't want to get you in trouble with your Baltimore constituents by making the public.
Hey, I keep it real. I told them on the doors what my team was. That's how you know I won't lie to you.
Okay. So, Delegate Smith, I'm trying to look at how you would go about effectuating these goals and changing the rates. And as everyone knows, and I say every day, math is not my specialty. So I want to make sure that I'm getting this right. In looking at the fiscal note, your bill for let's just a single filer or a married filer filing separately, the 5.75% tax rate, which is now Maryland's highest and only applies to single filers that make $250,000 up, you would drop the 5.75 rate down to people who make $96,000 and up. They would go up to 192, and then they jump to 6.5 and up from there. Is that fair? So we would be increasing taxes on people even down to the $96,000 single filer. That is fair. I just want to make sure that I'm reading this right. And then on the—
Sorry, I was bumbling with my unmute. I apologize.
Okay.
There, but yes, no, you're correct. But I want to point out that modification that you have, justly outlined, when you look at the overall portfolio of what it can mean to actually support working Marylanders, there is actually a recent poll conducted with the support of the Fair Funding Coalition that really showed that people oftentimes felt there are too many people not paying enough of their share, and many people who are willing to, even if they felt more comfortable, pick up a little bit more of the load because they realized overall, for example, I'm doing pretty well, but people have first cousins, they have neighbors, and they have other people who aren't doing as well. And one of the elephants in the room about people who are doing well in life, particularly if you represent a community of color where sometimes you might be one of the first people in that family or community to attain a certain type of wealth threshold, or maybe not wealth threshold, that's maybe being generous, a certain type of income. There are a lot of people relying upon you for assistance. So sometimes, it would be a lot better if we created a landscape where many people's basic needs are being met, and that we didn't always have to rely on the few people that are doing slightly better to either donate through charity or some other type of haphazard, response. If we just created an overall higher quality of life from the services that we're actually bound to provide to Marylanders.
And I appreciate that your concern. I know that you're a person of good faith that would like to use this money and do good things with it. But a lot of times when we get these income tax raise proposals that come through the legislature, we're raising taxes on the rich. We're only going to the rich. We're raising it on the top 1%, the top 10th of 1%. But one of the things I think, to be fair about your bill, is it would raise taxes on a lot of the lower brackets. So for example, if today you're a family and you make $100,000 in Maryland, you pay 4.75%. But under your bill, if it's, people filing married, you would pay 5.5% at 100,000. So you understand, and you are in very good faith admitting it, but this would be a tax raise on a very broad base of Maryland filers. Is that fair?
I think the fiscal note is pretty clear, saying that it's largely going to be a tax reduction on lower income and a tax increase on higher income. That's the broad overall portfolio of impact. We also know that the raw number, like the individual number in terms of an income tax rate, you can't look at that just as in isolation from the actual income. What that burden feels like at a 3 or 4% when you're talking about a very low economic bracket, that very few people are quite that low compared to people who are largely someone who's making 300,000, someone that's making 250,000, and someone that's making $1 million, 2 million, there's some big gulfs there. And the fact that that's a fairly flat tax reality right now, we are not realizing the full potential of our tax code to bring relief to all those other people that I feel that you are endeavoring to provide some level of advocacy through your question around. They would be best served by those who make much more money than them actually paying their fair share.
Okay, thank you very much.
Thank you.
Thank you, Delegate Buckle. Thank you, Delegate Smith. Seeing no other questions, I will move on to those who have signed up, starting with Dylan O'Neill.
Hello, and thank you for the opportunity to testify. My name is Dylan Grunman O'Neill. I'm a senior state tax policy analyst with the Institute on Taxation and Economic Policy, or ITEP. We're a nonprofit, nonpartisan research organization with a mission to promote fair, adequate, and sustainable tax systems. We are in strong support of HB 275 because it would advance all of these important goals. And I thought I'd focus my testimony today on the specific importance of having a modern progressive income tax that reflects the scale of today's economic inequalities. As you know, Maryland's tax system is regressive, falling most heavily on low and middle income families while asking the least of those who have the most. Another way of saying that is that the gap between high income Marylanders and working families is large before taxes. And then after applying taxes to fund all those needs that Delegate Smith mentioned, the gap is even larger. So this is largely because property, sales, and other consumption taxes are simultaneously vital revenue streams for public services, but are also inherently regressive. They fall hard on families who have to spend the vast majority of their incomes on housing and basic consumption of goods and services. And there's simply no feasible way, particularly with sales taxes, to link the tax rate to the taxpayer's ability to pay. Personal income tax, on the other hand, is essentially the only major revenue source available to states that can meaningfully mitigate the unfairness of those other taxes, because it is directly linked to the person's ability to pay. And so that is why it's crucial to have an income tax in the mix that is progressive, robust, and up to date. Maryland's income tax could stand to improve on all three of those counts, and HB 275 would really push in the right direction. Those lower brackets currently that start at $0, $1,000, $2,000, $3,000 of income are clearly vestiges of a very long, outdated structure. And then the remaining brackets above those are an improvement, but they still don't really reflect the distribution of income in Maryland today. HB 275 would spread out those brackets into increments that are more meaningful in today's economy. So to close with a couple of statistics to illustrate these points, I wanted to point out that this isn't a particularly broad tax increase. About 2/3 of it would apply to the top richest 5% of Marylanders, and 94% of the income would come from the highest income 20%, which is people earning over about $150,000 a year. So it is pretty well focused on those highest income folks, and as mentioned, is a tax cut for 60% or so of Maryland families. And with that, I will close and take any questions.
Thank you. Thank you. Oh, no questions yet. We got to take the next person first. We have Ashley Watson.
Thank you, Madam Chairwoman and members of the Ways and Means Committee. My name is Ashley Watson. I'm a case manager specialist for the Maryland Department of Juvenile Services at Cheltenham Youth Detention Facility, and a proud member of AFSCME Local 3167, as well as a single mother. I thank you for the opportunity to come before the committee to speak in support of House Bill 275, the Fair Income Tax Bill. As it stands today, the wealthiest 1% of Maryland households pay a smaller share of their income in state and local taxes than residents like me, and this is not fair. A fair income tax system would ensure that Marylanders are contributing the fair share of the state's budget. It would also reduce the increasing concentration of wealth and power in a few hands and lower barriers that hold too many Marylanders back economically. Before reforming Maryland's tax structure, we would have the ability to generate additional revenue that could be invested back into our state's communities. It will also assist in addressing the continuing issues I face as a state employee, working with Maryland's state agencies, where working with less has become the norm. When there are not enough resources allotted to public service agencies, it leads to understaffing, less services for the youth, and as well a hardship on communities. That means people are stretched thin to do extra work to make up for the vacancies. During the pandemic, there was and continues to be a lack of resources to keep me and my coworkers safe. We continue to provide the necessary services to Maryland's youth. More importantly, reforming the tax system will put money back into the hands of working families, especially like single parent households like myself, to be able to provide for our families and for their futures. Investing in these basic strengths, our economy and can dismantle the economic barriers that often hold Maryland's working families back. House Bill 275 aims to do just that, moving our state in the right direction by making our tax code more balanced and equitable by asking more of the high income households to pay more tax. I thank you for the time and I ask you to pass House Bill 275. Thank you.
Thank you, Ms. Watson. Any questions for either of the two who just spoke? Thank you both. Yes, there are. Delegate Palakovich-Carr.
Thank you, Madam Chair. Sorry for being slow on the draw there. Yes, a question for the witness from ITEP. Can you just explain a little bit more about how the tax brackets in the bill actually would lead to lower taxes for low and middle income residents?
Sure. So the total income tax that you pay is a combination of all the brackets that you fall into, of course. So this bill, someone right at that 95,000 or about level, while the last few thousand of their income might be subject to a higher rate, the majority of their income is actually subject to lower rates because these brackets are getting spread out and adjusted in more than just that one way. So so for someone in that income range, this would be about a wash. For lower income folks, those first three brackets currently apply to pretty much anyone. They do apply to anyone with income of at least $3,000. So I don't have the thing in front of me that I had earlier, but essentially lower income people are seeing a cut because the brackets that apply to them are getting spread upward and applying those rates to a smaller portion of their income. People in the middle are kind of breaking even. People at the higher levels are getting a tax increase.
Thank you.
Thank you. Any additional questions? All right. Thank you both very much. Thanks for joining us today at this hearing. Members, we're done with the hearing on House Bill 275, moving to House Bill 357. Delegate Palakovich-Carr.
Good afternoon, colleagues. For the record, Delegate Julie Palakovich-Carr here to present House Bill 357. So this is legislation that has to do with tax fairness for small businesses. And specifically, the bill closes a tax loophole that large profitable companies are using to avoid paying corporate income taxes. In order for me to explain basically the genesis of this loophole, I have to back up a step and just talk about the legal structures by which businesses basically set themselves up as. So we can think of businesses as falling into one of two categories, and that's corporations or pass-through entities. I think all of us are familiar with what a corporation is. They have a corporate board, they have shareholders, and historically corporations have been larger companies. And in light of that, Maryland and the federal government and many other jurisdictions impose a corporate income tax. In Maryland, our corporate income tax rate is 8.25%. Now, all other types of businesses are collectively known as pass-through entities, but you might know them better by names like an LLC or a partnership or a sole proprietorship. Pass-through entities historically have been smaller businesses. And in light of that, Maryland does not assess a tax directly on one of these types of businesses, on a pass-through entity. So just so we're comparing apples to apples, pass-through entities as a business pay 0% in income taxes directly to the state. Corporations pay 8.25%. The issue is that over time is that businesses have realized that they can save a lot of money on their taxes at the state level, but even more so at the federal level, by no longer being a corporation and instead changing their legal structure to something else, like an LLC. And there are companies that have made this transition over time. The problem has actually been very well documented at the national level by the Congressional Budget Office. Even just back in 1980, the number of businesses that were corporations versus pass-through entities in the United States was roughly equal. But now, a disproportionate number of businesses, 80% of all businesses, are pass-through entities. We also see a similar trend in terms of where income comes from, in terms of total business income. Back in 1980, less than 20% of all business income came through pass-through entities. Again, that made sense. Those were the small companies. But now it's more than half of all business income comes from pass-through entities. It's because of these behavioral changes by large profitable companies. And as the Congressional Budget Office concludes, this is really is a very costly loophole. At the federal level, it costs about $76 billion a year. At the state level, and the fiscal note for this bill points out that it's probably about $350 million a year that the state is losing out on. So who are some of these companies that are taking advantage of this tax loophole? Well, it's some of the biggest companies in America. Includes Google. Google used to be a corporation, paid corporate income taxes. Several years ago, they changed their legal structure to be an LLC. As such, they no longer pay corporate income taxes. Amazon.com is an LLC. They don't pay corporate income taxes. General Electric and many other businesses like them have a parent company that's a corporation and many subsidiaries that are LLCs. And those subsidiaries do not pay corporate income taxes. Here in Maryland, Clark Construction and Giant Food are both LLCs. They both have revenues on the range of $4 to $5 billion a year. Those are not small businesses, yet they don't pay corporate income taxes. If we look at the 20 largest companies that are domiciled in the state, and we're measuring that by their total gross receipts or their sales, 9 out of 20 of those companies in Maryland, so almost half, are LLCs and therefore not paying corporate income taxes. Meanwhile, there are many, many small businesses, truly small businesses, not just on paper, but in reality, small businesses in Maryland that are paying their fair share of taxes. And I actually, just did a kind of cursory review of tax data here in Maryland and found many small businesses that, because they are set up as corporations, they are paying corporate taxes to the state, even though they are small businesses. I'll give a few examples here, but these are all companies that have less than $1 million a year in sales. It's everything from a catering company in Baltimore to a building company in Stevensville to a tax services company in District Heights, a carrier truck company in Hyattsville, an electrical installation company in Savage, and a technology company in Hollywood. So if these truly small businesses are paying their fair share of taxes, why are the Googles and Amazons of the world, exempt from this? So I'm urging the committee to please act and to close this loophole, to prevent these large profitable companies from exploiting this tax loophole, and to stop masquerading as small businesses for tax purposes. Finally, I will note we do have a lot of pieces of written support, written testimony in support of this legislation, including from the AFL-CIO, AFSCME Council 3, AFT Maryland, the City Union of Baltimore, Maryland Communities United, League of Women Voters, Maryland Fair Funding Coalition, Maryland Legislative Coalition, Maryland PIRG, and Maryland Nonprofits. Thank you.
Thank you so much. With the question, Delegate Rose.
Thank you, Madam Chair, and good to see you, Delegate. Just a question for you. When you mentioned the list of small businesses that are not able to take care of what you're calling a loophole, they could certainly make the choice to become an LLC, could they not?
They could, yes.
Okay. And when you say loophole, it makes it sound as though it's like they're trying to skirt something. If these are the laws on the books and these are the options available, to me, I would not say that's necessarily a loophole. It's from the laundry list of ways you could incorporate. Is that correct?
And I apologize, my audio is cutting out a little bit. I think I got the gist of your question. I don't mean to insinuate that any of these companies have done anything illegal. These are the current laws in the books in the state and at the federal level. I'm pointing out the injustice of these current laws, and I think it's time for them to change.
I appreciate that. Just my last comment, it's one thing to have an opinion of injustice, but if those are the choices, any of those small businesses could certainly choose to become an LLC and have that tax advantage, which if they're struggling, I think that might be a great idea for them. So that's just my last comment.
Yeah, and I'll just say, I gave those an example. I think I can set aside the ones that are currently corporations. If we just look at businesses that are set up as LLCs in Maryland, there would be a similar list, I think, in terms of the range of sectors, business sectors we would see that are true small businesses with revenues under $1 million a year. And I don't see why we are holding true small businesses, putting them on the same playing field for tax purposes as we are Google or Giant Food or Clark Construction or Amazon.
Just one last follow-up question. I mean, is it not the case if somebody wanted to become incorporated and they wanted to become an LLC, it's not always the big guy. It often is a small company. I know several companies that are 1 to 10 people. So it's not the big versus the little. It's a mechanism, and people have to make their own decisions, don't they, to decide how they're going to incorporate in order to actually make a profit and exist. Isn't that the case?
Yeah, businesses have their own choice in terms of how the legal structure that they're going to choose to set up. And I'll say with this legislation, we're differentiating based off of revenues. So for businesses that are under $1 million, and I think objectively those really are small businesses, they aren't impacted by this legislation.
Thanks.
Thank you, delegates. Delegate Fellmark.
Thank you, Madam Chair. So I just want to kind of clarify based on the last few questions and the answers. It's up to the business to decide how they want to organize and structure legally, right? So is it accurate to say what this law is suggesting is that how we tax businesses should not be based on how they chose to structure themselves, because there may be a whole range of other factors that influence how they choose to structure themselves, but how we tax them should be oriented more towards the size of their income.
Yeah, thank you for that question. I would agree with. Yeah, I would agree with that assessment. Our current structure for taxes of differentiating between corporations versus pass-through entities dates back a very, very long time in our tax code, probably longer than any of us have been alive. The business world was a simpler place then, but in light of, in the recent decades, behavioral changes by companies, I think it is time for the tax code to make differentiations, not just on the legal structure of the company, but on other metrics. And this bill does that by looking at the annual revenues for the company and setting different tax levels based off of that.
All right, thank you both. Seeing no other questions for Delegate Palakovich-Carr, we do have 3 people signed up, and then we'll take questions after that, starting with, we have Ms. Antoinette Ryan Johnson. Welcome.
Good afternoon. Good afternoon, Chairwoman Kaiser and members of the House Ways and Means Committee. My name is Antoinette Ryan Johnson, and I am the president of the City Union of Baltimore, AFT Local 800, the union representing a number of Baltimore City government workers. On behalf of the thousands of municipal employees working to serve the residents of Baltimore City, the City Union of Baltimore enthusiastically calls for a favorable report of House Bill 357, the bill that closes a loophole by which large corporations can claim their income as taxable under the personal tax rate rather than the appropriate corporate tax rate. You have my written testimony, so I want to share some highlights. Our members provide vital services so that local government can continue to work for Maryland residents. We are on the other end of the phone when someone calls 911 or 311. We help pick up and sort trash and recycling. We make sure your water is clean and safe to drink. We are risking our lives so that the state can make it through this pandemic. Indeed, we have unfortunately lost some members who have given their lives in service to our city so that residents may make it through this terrible crisis. The pandemic has certainly harmed local government's ability to raise the revenues needed to pay for these services. As you are aware, anticipated aid from the federal government has been slow to materialize, so we often are reliant on state help to continue to provide these services. For the state to be able to help us at the local level, it is more important than ever that the state closes loopholes that the ultra wealthy have been able to exploit. The tax loophole that currently exists has given ultra-wealthy corporations a big perk, namely being able to claim their income as taxable under the individual, not corporate tax rate. If Maryland is able to successfully weather this pandemic storm, they will need to end the loopholes we all as a state can no longer afford. I would hope the people who lead these mega wealthy corporations will support the closing of this loophole too, as they also rely on basic government services, 911, clean, healthy drinking water, access to safe roads, or even the services of the local health departments to get through this pandemic. If we do not provide these basic services to Maryland residents, we, both rich and poor, just won't survive this pandemic. If we do not find ways to pay for these services, they just will not happen. Again, I urge a favorable report for House Bill 357. Thank you.
Thank you very much. Michael Mazeroff?
Thank you, Chair Kaiser and committee members. Again, I'm Michael Mazeroff from the Center on Budget and Policy Priorities in DC, and thank you again for the opportunity to testify in support of this bill. You have my written testimony. The bill would impose a 4% tax on the distributed profits of large pass-through entities to bring their tax treatment more in line with that of taxable corporations. The tax would not apply to sole proprietors, and profits plowed back into the business also would not be subject to the tax. And even if the profits were distributed, they would still receive more favorable tax treatment than profits distributed as dividends to regular corporate shareholders. Pass-through treatment, that is exemption from the corporate income tax, was intended to benefit small businesses. But many pass-through businesses now are not small. For example, many billion-dollar hedge funds are organized as pass-throughs. Moreover, many pass-throughs have much higher profits than many small corporations that are still subject to the corporate income tax. The IRS reported that in 2013, there were 490,000 taxable corporations with profits below $1 million, representing 98% of all taxable corporations with profits. If there are this many corporations with profits below 1 million that are subject to the normal corporate income tax, surely it is fair to expect pass-throughs with profits above $1 million to pay some tax as business entities. And since most pass-throughs get all the non-tax benefits of taxable corporations, there's no longer any justification for completely exempting those businesses from tax at the entity level. In making this long overdue change, Maryland would not be alone. The District of Columbia imposes a tax on pass-throughs at the full corporate tax rate, as does New York City. California, Massachusetts, and Illinois also impose taxes on the profits of some types of pass-throughs. And New Hampshire, Tennessee, and Texas tax pass-throughs essentially the same way they tax regular corporations. Large pass-throughs differ little from taxable corporations and should therefore be subject to some type of tax as business entities. And then I therefore urge the committee to favorably report HB 357. Thank you.
Thank you. Next, we have Christopher Meyer.
Thank you, Madam Chair, Mr. Vice Chair, distinguished members of the committee. My name is Christopher Meyer. I'm a research analyst at the Maryland Center on Economic Policy. I'm testifying in support of House Bill 357. The COVID-19 pandemic has created severe hardship for Maryland families and increased strain on public services, but it simultaneously reduced revenue needed to provide those services. And these challenges come on top of pre-existing underinvestment in Maryland communities, things like public schools and public health. Despite the hardship caused by the pandemic, large businesses and wealthy individuals have seen their incomes skyrocket. So, as others have said, House Bill 357 would eliminate a special tax break that enables large businesses to avoid paying corporate income taxes. Growing numbers of large businesses have organized as pass-through entities like LLCs, partnerships, and S corporations over the last several decades, which enables them to exploit this tax rate. House Bill 357 would levy a 4% tax on profits in excess of $1 million on the largest pass-through entities. So data from the IRS indicate that likely only about the largest 2% of pass-through companies would be paying this tax. The bill further protects true small businesses by exempting all sole proprietorships. And as Michael Mazarov already pointed out, the District of Columbia taxes all pass-throughs at the full corporate rate. House Bill 357 would raise more than $300 million each year, which would enable us to invest in foundations of thriving communities, things like public health and world-class schools. Strong evidence shows that asking large businesses to pay their share is consistent with a strong and equitable economy. Businesses decide where and how much to invest based on factors like economic demand, skilled workers, transportation infrastructure, or simply where founders live. State and local taxes are only a small portion of most businesses' cost structures. And the Pro-Business Council on State Taxation analysis pretty consistently finds that Maryland has among the most pro-business tax structures nationwide. About 3/4 of pass-through income in Maryland goes to the wealthiest 1% of households, and it by definition goes to those with significant built-up assets. This is an equity issue, as only minuscule numbers of Marylanders of color belong to this class, and it's also an economic issue. Research out of Johns Hopkins University shows that during an economic downturn like we're in today, families who are living paycheck to paycheck spend 10 times as much of each additional dollar of income as those with the most built up assets. So asking large businesses and wealthy individuals to pay their share and using that money to invest in public services that create decent jobs will generate more demand in our economy, which strengthens sales at local businesses. Thank you for your consideration. I respectfully ask for a favorable report, and I'm happy to take any questions.
Thank you very much. Any questions for the three who just testified? If not, thank you all very much. Thank you for coming in today. Members, we're done with the hearing on House Bill 357, and our last bill of the day is House Bill 474. Delegate Guyton.
Thank you, Madam Chair and members of the Ways and Means Committee. For the record, I'm Delegate Michelle Guyton, District 42B in Baltimore County, and I often bring before you things about which I am very passionate. Today is no different. Today we're going to talk about wine. So I am here to present House Bill 474, which extends an existing tax credit to Maryland's wineries and vineyards. So this credit's been in existence since 2012 and has been highly successful in assisting the small but really important industry to make the continuing capital investments it needs to grow and to expand. So this credit supports Maryland's public policy goals of preserving working agricultural lands and supporting the sustainability of agricultural tourism in the state. So a lot of you know that my district has some of the most beautiful and productive farmland in all of Maryland, but there is constant threat of losing these lands to other kinds of uses because of the difficulty that farmers have keeping up with the global competition. So encouraging farms to switch from commodities like grain to value-added products like wine allows them to increase profit margins and to stay in farming. So on many of the farms, the vineyard and winemaking operation only occupies a portion of the farm, but it makes the revenue that allows the rest of the farm's acreage to stay agricultural. So House Bill 474 does not expand or change the current tax credit program at all. It's just extending it. So since 2012, the program has provided income tax credits to businesses that incur qualified capital expenses. These expenditures are in connection with establishing new wineries or vineyards or capital improvements at existing wineries or vineyards in Maryland. The credit only applies to 25% of the eligible capital expenditures. And there is a statewide annual limit of $500,000 for all businesses that do apply. The credit was initiated to replicate a similar credit that's given by Virginia. And since its initiation, sales of Maryland wines have grown by over 100,000 gallons. That is a lot of wine. So in 2019, 31 wineries were approved for this credit. And for those reasons, I introduced House Bill 474 to extend this credit for 5 years and to help keep Maryland's wineries growing and thriving. Thank you very much for your consideration. And I'd like to turn it over to my panel.
Well, thank you, Delegate Guyton. Any questions for Delegate Guyton? All right, we'll first start with Pat Roddy.
Madam Chair, members of the committee, my name is Pat Roddy. I'm here today representing the Maryland Wineries Association in support of House Bill 474. We'd like to thank Delegate Guyton for introducing this legislation. This has been, as she said, a part of Maryland tax policy since 2012. In that time, Maryland wineries have grown from just 69 to over 110 wineries. We also have 17 that are currently in development. This tax credit is efficient, affordable to the state, and has a positive return on investment, not only in terms of tax revenue, but also in terms of supporting other public policy initiatives that the state of Maryland has as its objectives. Let me focus for a second on the 100,000 gallons that Delegate Guyton talked about. If you change that into tax revenue, that 100,000 gallons annually results in $645,000 approximately in sales tax and excise taxes. That's every year. That's in addition to the jobs created and the other important public policy aspects that Delegate Guyton talked about when this General Assembly supports these small businesses, Maryland wineries. I think every one of you in your districts, in your counties, and the state of Maryland have seen branding materials about our state, asking people to please visit and spend time and tourism dollars. Almost without doubt, every single one of them feature Maryland wine as part of the reason people should either travel to different parts of Maryland or should come to Maryland and spend time. Well, this is an important industry for our image. It's important for the agricultural preservation policies of the state, and it returns a positive tax number for the credit that is outlaid. It's limited and is leveraged by the fact that it is only 25% of the total capital expenditure. So, Madam Chair, with that, I'd like to turn it over to the other panelists who are Maryland winemakers to tell you about their operations and how this credit has helped them.
Thank you so much. Robert Butts.
Yes, hello. I'm Robert Butts. I'm the owner of Windridge Vineyards and Windridge Farm, and testifying in support of HB 474. I'm a lifelong farmer, a second generation row crop farmer in Montgomery County, along with my 3 brothers. We planted our first wine grapes in 2011 as an effort to diversify our farm, increasing urbanization pressure in our county. Today, we produce about 5,000 cases of wine produced from our fruit. And while our vineyard is small compared to the size of our row crop farm, the revenues from the wine business have now surpassed that of our legacy farming businesses. And I think this highlights the ability of farm wineries to produce meaningful revenues on relatively small acres, which can help preserve agriculture in more urban counties like Montgomery. Put in perspective, gross revenues from an acre of corn can be around $1,000 an acre. Gross revenue from grapes can be about $10,000 an acre. Put those same grapes in a $30 bottle of wine, and those revenues can be about $100,000 an acre. Our farm used the winery and vineyard tax credit to offset a portion of the costs associated with the construction of our new winery and tasting room. And this tax credit was, in fact, an important part of our ability to afford the project. This building is obviously essential for our ability to make and sell wine. And the construction of our facility allowed us to make the transition from a grape grower selling fruit to others to being a complete retail winery. This transition now also enables me to employ an additional 25 full and part-time staff. And because our guests come to the farm to enjoy a lot more than just wine, this business, or our business, now supports a multitude of local vendors. More important than just the economics, though, we're proud to have built a business that showcases Montgomery County agriculture and provides a venue for our citizens to enjoy the Montgomery County Ag Reserve. The winery and the vineyard tax credit is an important tool to enhance the growth of the Maryland wine industry and is worthy of your continuation. Thank you very much for your time and consideration.
Thank you so much. Susan White.
Hello, and thank you for your time. I'm Susan White, and I am here to support the extension of the existing tax credit for Maryland wineries and vineyards. I am the owner of Robin Hill Farm and Vineyards in Brandywine, which is located in southern Prince George's County. We are a family business, and we've been farming since 1955. We have diversified throughout the years. We started out as tobacco and hog farmers. We had a 100-acre nursery, and we've been involved in agritourism for over 50 years. We're very dedicated to keeping our family farm in agriculture. So in 2014, we planted our vineyard, and then we opened our on-farm winery in 2017. Our winery does produce about 1,500 cases a year, and we have 12 employees. So the winery tax credit, it's helped us to purchase necessary equipment that we need for the vineyard. We purchased a hedger and a leaf puller, which is very important in canopy management to make quality grapes. And as we know, good wine starts in the vineyard. We've also been able to purchase equipment in our winery that has helped to boost the quality of our wines, which in turn has helped us to gain award-winning wines and medals in local and international wine competitions. We are part of the Legacy Wine Trail. So there are 4 on-farm wineries right here within a 9-mile radius. And our winery attracts customers from all over Maryland, the surrounding states, and tourists who are visiting our nation's capital. So our guests get to come down, enjoy a day in the country. They can experience a working farm and then sip wine, of course. We do support other local farms and small businesses. We do emphasize buying local. We have a small vendor fair in November, and then we also have vendor Saturdays all throughout the year to support our other local businesses. We've been featured by Experience Prince George's, the Maryland Office of Tourism, Southern Maryland Agricultural Development Commission, as well as Maryland Public Television's Farm and Harvest and Farm Her TV. Our next project is going to be purchasing an automated bottling line, which could cost over $100,000. So we are hoping that the future tax credits are going to help to defray this cost. So I do ask for the continuation of these tax credits, which will not only help us, but it's going to help other existing wineries and new wineries to achieve higher standards and quality wines, which of course in turn will improve the name for Maryland wines and Maryland agriculture. So thank you for your time.
Thank you so much. I think we have one more person signed up, and I moved that piece of paper. One moment, please. Sorry about that. And that is Phineas DeFord.
Thank you. Good afternoon, Madam Chair, members of the committee. My name is Phineas DeFord with Bordy Vineyards. Bordy is Maryland's oldest winery, and as luck would have it, 2020 marked our 75th year in business. My family has farmed our land in Baltimore County for 5 generations, and I represent the 3rd generation to be actively involved in the winery. My grandfather was a grain and livestock farmer who in 1965 planted his first 5 acres of grapevines as a way of diversifying operations. That decision, coupled with the purchase of Bordy Vineyards in 1980, is ultimately what saved our farm. Today, we farm in 2 locations, Long Green Vineyard located on our home farm in Baltimore County and South Mountain Vineyard in Frederick County. Both farms are in permanent preservation through the Maryland Environmental Trust. Together, the farms total about 360 acres, of which 50 are dedicated to growing grapes. Before COVID, we had 23 full-time employees, and I'm proud to say that all of them are still with us today. Owning a winery and a vineyard is a capital-intensive business. There's an old saying in our industry, you've probably heard it before, if you want to make $1 million in the wine business, you start with $2 million. A startup winery can expect to spend $15,000 an acre in vineyard establishment costs, $100,000 in vineyard equipment, $1,000 for each oak barrel, upwards of $30,000 for each stainless tank, not to mention the costs of building a winery and tasting room, and all of that before the first bottle of wine is ever sold. Even established wineries like Bordy are constantly replanting and expanding vineyard acreage, buying new barrels and vineyard equipment, the list goes on, which is why the winery and vineyard tax credit is so critical to our industry. Bordy has applied for and received tax credits each year that the program has been in existence. In 2013, we completed construction of a new winery building, including the purchase of 32 new stainless steel tanks, for which we received a tax credit of nearly $113,000, which was extremely helpful. The improvements in wine quality as a result of this $2 million investment were dramatic and immediate. Since then, our wines have gone on to win numerous prestigious awards in local, national, and international wine competitions. And before COVID, we were receiving nearly 80,000 visitors each year, making Bordy one of the most visited destinations in Baltimore County. One of the things we're most proud of is our Thursday afternoon farmers markets held each year from May through September, where we invite local producers to sell their goods at the winery. As Bordy continues to grow, we will need to invest in vineyard expansion and additional winemaking equipment. And knowing that the winery and vineyard tax credit is there to help offset some of those costs is a huge incentive. I would like to thank Delegate Guyton for sponsoring House Bill 474, and I ask that the committee vote in favor of expanding the winery and vineyard tax credit for another 5 years. Thank you very much for your time.
Thank you, Mr. DeFord. I think I saw someone's cat show up on screen there for a moment. Any questions? Delegate Feldmark.
Thank you, Madam Chair. Thank you all for your testimony. I have a couple questions that I think might be for Mr. Roddy, if you're able to answer them. I was looking at the fiscal and policy note. Do you know historically, I think you said the program's been in place since 2012. At $500,000 as the cap, has it been fully subscribed throughout that history?
Excuse me, Delegate, most years it's oversubscribed. So
Okay.
most years the applicant has to take a percentage less than the eligible costs which they submit.
Okay. And I saw the note.
That is, last year we were undersubscribed by about $25,000, almost the 500, but most years it has been oversubscribed.
Okay. And when it's oversubscribed and there's the proportionate reduction in the amount of the credits, is it the amount by which those credits are reduced that folks are allowed to carry forward for 50?
Correct. They are not, they are not allowed to carry forward the eligible amount. They are only eligible to carry forward the actual amount of the tax credit.
If it exceeds what they.
Correct.
Okay.
Correct. So if they don't have taxable liability in that year, which is greater than the tax credit, they then get to carry forward the balance against taxable liability in future years, but only of the tax credit and not for the eligible amount.
Got it. Thank you very much.
You're welcome.
Thank you, Delegate Feldmark. Any other questions on Delegate Guyton's bill? All right. Thank you to Delegate Guyton and to the members. We're done with the hearing on House Bill 474. If there's no other questions, and I have no other announcements, if any subcommittee chairs or anybody else has anything good for the order. All right, well, I guess that's it. I think early childhood met earlier today, but no other subcommittees announced. I already mentioned that we're not voting in full committee tomorrow, so I'll see y'all on Monday or Tuesday. Have a good week.
Kudos to early childhood for some good work today, too.
Yes, congratulations.
They did very well. I did too.
Goodbye, everyone.